Hello, everybody. Welcome once again to another session of sharing session today with Nicholas. And today's topic is going to be pretty interesting. We'll be talking about stonks, basically the meme stocks. And we are looking to cover three key points today. The first one is basically, are we looking at a Fast and Furious sequel to the short squeeze trade that happened back in January 2021? And is this going to be a repeat of what happened at that point of time? So the second point is basically will be covered by myself. I will talk about how to actually position size into meme stocks if you're interested to actually trade them. And last but not least, we want to identify the AMC number 2 candidate over here today. Okay, so without further ado, I'll hand it over to Nicholas, who will actually talk a little bit on the background of what is going on for this short squeeze stocks and basically highlight to us, is this going to be a repeat of January 2021? Nicholas, please.
Okay, man. Thank you, Royston. Hey, and hello, everybody. Thank you very much, Royston, for having me here again today. Today, we are talking about such a controversial topic and such a topic that's in the news today. We're talking about stonks. That's right, gentlemen. We're talking about meme stocks, meme stock that has been taking the headlines for the last week or so. The question is, like what Royston said, will it continue, or is it just going to peter out like what it did probably in January? What are some things to look out for everybody? Okay, so without further ado, let me just jump straight in. Okay, before we go, as normal, we have to clear this part of housekeeping, if you may. All recommendations. So I mean, this whole video is intended for information, for education, and it's purely both Royston's and my view, not intended for us to recommend for you to buy or sell stocks or whatever, because we don't know your risk profile. You should consult your own financial advisor for that. Okay, so with that part over, let's just jump straight in. Folks, this is what we're talking about last week. This is what happened. The whole bunch, well, this is just a selected bunch of meme stocks or stonks for that matter, led by AMC. It just shot through the moon, again, another term from the Reddit warriors, dragging and pulling GameStop, BlackBerry, and maybe a few others. Now, this is the second time it's happened because, like Royston mentioned, it happened in January again. But also, please notice, this January move led by GameStop then, okay, also ended up with a flat third belly flop, okay, before it just quiet down and then starting to take a bit more momentum. Let's zoom in straight into AMC because I think that was the trigger point that everybody acknowledged the whole story to be. This is a screenshot of AMC's movement in the last month and a half or so, from the beginning of May. You can tell, folks, that it was all along just meandering along around the $10 line for some time, and this happened all the way through from the last couple of months. And then the week before last, started to see some momentum, very strong momentum, green bars all the way. More importantly, green bars highlighted together with a strong increase in volume, okay, until this big red candle and then this doji down here. What happened down here was end of the month. At the end of the month, or the end of closing that day, on the end of May, AMC announced one key piece of news. They placed out roughly 8 million shares to a key investor, a hedge fund who was very much involved in distressed assets, a company called Madrid Capital. They placed out and raised 230 million, and this is obviously very smart for AMC, the company, because they are obviously struggling to keep their bills paid and the lifeline going. And what they had to do was to raise money to be able to, extend their life for a few more months. Madrid Capital bought the stock at not big discounts to the share trading price, prevailing price at that point in time. They bought roughly about 8 million shares, paying about $27 or so. Okay, what happened was that immediately after that purchase, the next day, the short just went to the moon, almost doubling at one point in time. Remember, they came in around 27 bucks, it went up to $70, okay? Making themselves a huge, tidy profit along the way. The stock has since settled down. Last night, I believe this is based on last week's closing. Last night, the stock settled around here, mid-50s, looking like it could go again. Or, things are still undecided right now, but certainly it's still very much a stock in play. All in all, the volume shot up to a high of 700 million here, about 300 million down here. Why? Everybody was all talking about a short squeeze whereby the stock was being pushed up to get a shortest or key shortest, corporate shortest or traders out of the game by forcing them to buy at a higher price. Whether it's the truth, not the truth, reality or not, Nobody knows, but it's a story that caught fire on the internet, caught fire on social media, and caused everybody to actually jump in. Okay, let's look at stock, short interest in some of these stocks. Okay, this is something from FactSet. Okay, and this is as of late last week. I think this was a 3rd of June reading. Okay, now you can see here, we talk about AMC. Based on this report, AMC, okay, has a 21% short outstanding interest. What this means is that they believe that up to 20% of the total market cap of the company, in this case about 5.4 billion out of 25 billion, was actually lent to shortists, traders who believe in shorting the stock to make money if the stock price collapses. And this is what's caused a short squeeze, because the higher the price goes, these people who are shorting it, the stock, have to buy back at a higher price, and in so lose quite a lot of money. Okay. Now, why does anybody want to short the stock to begin with? Okay, purely because market price discovery, people short stocks because they believe the stock's not worth this price. They believe that the stock price, the stock is worth a lot lower. Okay, why? Because there's no fundamentals that support the company itself. Again, from FactSet. This basic, I'm not going to go through the deep dive of AMC and to see what sort of stock price or what sort of fundamentals are based, but just get a sense of where Wall Street has piqued their interest in AMC. This is based on a collective reading of all analysts out there who covers AMC stock in this case, okay, with the red bar here. Now, 60% of analysts that covers this bar calls this a neutral, whole, whatever. 40% calling it a sell. 0% calling it a buy. So these are all analysts, mind you, analysts who are driven by fundamental analysis, looking at, you know, the balance sheet, cash flow, income statement, etc., etc. In fact, their targets for AMC stock is at $5 a share, compared to, based on last Wednesday's or Friday's close or Thursday's close, $51 a share. Okay, so folks, we are so far away. It's 90% away from the target, but still the stock keeps going up. Why? Okay, why? That's a good question. What fundamentals? Yes, what fundamentals? Thank you, Royston. Okay, meanwhile, experts. Remember I told you about the placement done, okay, the AMC did on Tuesday last week to Madrid Capital. Madrid Capital bought $27 a share, and in the very same day, okay, all the next, they sold out their position, okay? It was clearly not a long-term fundamental hold. Folks, they don't have diamond hands, paper hands, okay? With paper hands, okay, why? Because a bird in the hand is worth two in the bush. In fact, Madrid Capital made close to $40–50 million a day. That's pretty cool, okay? Without having to suffer the wrath of a diamond hand, okay? And there was no 10D too that they took $50 million. I think what's happening at play is very much behavioral. Behavioral caused by the onset of social media, onset of this whole Reddit warriors, retail power, okay? YOLO, you only live once, so why save your money in the bank? You can make easy bucks in the market like that. I will not sell AMC, not on Monday itself. Why? Because the influence on social media is so strong and everybody's doing this. Folks, in behavioral finance, which I am a key proponent and study of, this is called herd mentality. Not herd immunity, like what we know about COVID jabs, herd mentality, okay? And this is going to be quite significant because why? Everybody's connected on social media itself. Okay, so I just want to conclude this big part, okay? We know how it started, okay? I told you about trigger. In similar fashion, GameStop started there. But don't forget, GameStop ended flat in its face. So let me ask you this. What do you think is going to cause the party to end this time? Or is the party going to continue partying on for a longer time period, allowing people some skin at the game, you know, entry point? Nobody knows the answer, but I can give you certain clues, okay? In 2016, I wrote this piece of paper. Yes, that's me, folks, okay? And this was in the Business Times. And I talked about Chinese equities and the bubble down there. Will it end in tears? Okay, this was 2 weeks before that bubble collapsed. Again, I'm not trying to blow my horn or whatever.
Crystal ball, man. Crystal ball.
Yeah, okay. In this article, okay, I talk about two things about how all these sort of bubbles sort of deflate in the end. Liquidity, okay? And the liquidity in this sense will come from the standpoint of brokers pulling in their credit lines, okay? And this is going to happen. All we need is just one small broker okay, significant enough to say, hey, maybe we shouldn't extend so much credit lines to allow people to play AMC and all these meme stocks on the long side, okay? Let's call back some lines, or let's increase our margin ratios. When that happens, there is a tightening. When that tightening goes out to the rest of the market, what happens? The next broker, the next broker, the next broker will then say, hey, we better move first. Every risk department will be having huge emergency meetings and say, hey, should we increase the margin requirements for anybody to go long on AMC? When that happens, you're going to see this whole thing just ripple across the street. And that's when the party ends. Just like in January, when Robinhood, okay, had to tighten their credit because their broker dealers on the behind them was not able to fund them with any credit lines to allow them to continue to allow their customers to continue trading the way they have. Ridiculous. Okay, so I'm going to end here because we're going to go over to the key section of the whole presentation, which is Royston, because he, the man, will tell you what to do. Over to you, man. I mean, any questions now, or we can take it later also.
Yeah, thank you, Nicholas. Very interesting. And I do concur with you that at the end of the day, once liquidity starts to tighten, that's where potentially the party might end. But at this point of time, when the music is on, we got to jiggle along with it. Right? Am I right?
Yeah, boogie one.
Okay, man.
Boogie
So
one, yeah.
Okay, so let's go to my portion. So my portion, let's go to a quick one. Today I'll actually be covering on how to actually position size into meme stocks. Over here, again, we are not recommending that you guys get into meme stocks because they are highly volatile. But today, if you decide to kind of like punt it, just to get into the action, be a part of the apes, for example, that's how you should be looking to. I'll basically show you a simple way to actually position size for this kind of positions, for this kind of stocks, so to speak, so that at the end of the day, you can continue to ride the uptrend, but be also nimble enough to actually exit once the stock actually kinds of like turns around. So that's going to be the second portion. And lastly, I will talk about what might be AMC number 2. So that is something of interest to some people as well. Okay, so without further ado, let's get started.
Let's do this, man.
All right, so you can see over here, a lot of diamond hands, a lot of Wall Street bets, and these are some of the very popular kind of rated stocks or meme stocks that people have been talking about, Beyond Meat, Game Stocks, AMC's, Virgin in the past, and they are all now back in vogue again. Again, Nokia, BlackBerry, these were some of the meme stocks back in January, all right, and they could again be something that these traders might want to focus on, but later we'll take a closer look at what might be a better candidate. Okay, but today's topic, I want to be covering a very simple 5 steps process as to how, if today you are interested into buying into this kind of meme stocks, how to actually position size well. Okay, so this is going to be quite conservative. So we start with step 1. Step 1 is basically to run the short squeeze checklist. So what you can do over here is basically to look for stocks with high short float. So you want to be identifying stocks whereby potentially there could be a short squeeze in play. So these are stocks that typically have a high short float. Later, I'll show you an example. And at the same point of time, you want to know that there's going to be rising investor interest. So that can be seen in terms of a strong rising volume in the counters that are being traded. Again, I'll show you an example later on. So that is step 1, to basically identify some of these candidates. And once you have identified that particular candidate that you're interested in, the next step, which is step 2, is basically you have to define how much you are willing to lose. And just like what AMC and GME's management have kind of like highlighted publicly, that investors at this point of time who are buying into AMC's shares or GME's shares should be prepared to lose all their capital. So the management, the CEO have publicly mentioned that, hey, you know what, you guys better be prepared to lose it all. So don't expect that when the downturn actually comes, or the turnaround actually comes, a lot of the stock could actually see a 80-90% drawdown in their share price. So that's not going to be quite surprising. So assume that you today are very comfortable in terms of just punting $1,000. So be prepared that this $1,000, at the end of the day, you might not get anything out of it. But today, if you're very comfortable with a $1,000 at risk capital, that's fine. So later, I will refer back to this figure again. But step 2 essentially is to know how much you are willing to lose. Next is step 3. Once you have entered in the stock, basically what you can do is to actually put in a trailing stop loss. So today, for example, if you were to enter AMC at $32, all right, AMC today, of course, it's not at $32, it's probably around $50+ already. But assume you enter AMC at $32, and if you wish to have just say a $10 downside, ultimately your stop loss is going to be $10 per share. So you can put in a stop loss at 22. But what you can do is actually to put in a trailing stop loss. So in this example, if stock goes down to $30, the stop loss will remain at $22. So you'll be fixed at $22. But in the event that the stock goes up to $35, that's where your stop loss level will be incrementally increased. So over here, it will increase to $25, such that the difference between the current price, $35, and the stop loss level is $10. Right? It's $10. So when the price goes up to $42, that's where your stop loss will increase to 32, which is now your break-even level. So that is your cost level, and basically what you're playing with is the banker's money. So this kind of stop loss will allow you to continue to ride the uptrend, but at the same point of time, the moment the share price actually declines, that is where you'll be very nimble in terms of getting out immediately. All right, so this could be a way to actually set your stop loss to partake in the action of meme stocks, highly volatile meme stocks, but at the same point of time, know that you would want to get out of this party ASAP, all right, once the music actually ends. So that's step 3. But take note, step 3B, the potential losses could be more than $10 in some of these cases. This is mainly because of the price gapping down, which is very common for this kind of very volatile stock. So today, for example, the stock closes at $50. And you put a stop loss, say at $45, but it could very well open at $40. All right, so it's very common for this kind of highly volatile stocks. So if in the first place you are prepared to lose more than $10, you should be conservative. All right, you should be conservative and potentially assume that you have a stop loss of $15. Okay, assume that you have a stop loss of $15 per share. All right, you can place your stop loss at $10, but assume that your stop loss at the end of the day, or the total amount of money that you might potentially lose, is $15 per share. So that's where goes to step 4, whereby we actually calculate the number of stocks to own. So this is basically allow you to kind of like position size appropriately. Today, you have an at-risk capital of $1,000. How many shares should you be buying? So based on your stop loss amount of $15, which we have calculated over here, the total number of shares to buy is simply your at-risk capital of $1,000 divided by $15. So essentially what you should be owning is buying into 67 shares, and be prepared that at the end of the day, you might not be getting any form of capital back by playing into this stock. So it's a high risk, but potentially high reward at the end of the day. Last but not least, respect your game plan. This kind of participation in this kind of meme stock is really not advisable for new investors. So for those who are pretty new to this investing game, you should not really be actually kind of like punting this kind of stocks. And ultimately, if you choose to do it, only risk what you can afford to lose. And that's why very, very clear right from step 2, I know that, okay, today, if I'm only willing to lose $1,000, I'm fine with that. It allows me to sleep well at night. That's exactly what I can be playing with. And for that kind of amount of capital, essentially, I can only buy 67 shares. So this is a kind of very simple 5-step process to actually position yourself into meme stocks so that you can partake in the party, but at the same point of time, also limit your potential outlay ultimately. Okay, so that is from me in terms of the simple 5-step process to position yourself. Now we go into a little bit more exciting into how to actually identify the next AMC 2.0. So what I have is actually this app called Stock Tweets, which is actually free for everyone to actually download. So you can actually go and download, and for them, they actually track the trending interest of what the retailers are actually looking at this current point of time. All right, it's being refreshed every 5 minutes. And basically it tells you which are the stocks that are currently trending or is basically getting a lot of attention from the retail public. And you can see from this list, number 1 right up there is Clover Health. All right, Clover Health is actually a recently IPO'd stock that went through SPAC by Sharmef. And because of the appreciation of the stock of late, essentially he is now back as a billionaire once again. All right. So he has got to thank all this apes for kind of like pushing the price of Clover Health pretty significantly. So you can see over here the price change is very substantial, and Clover Health potentially could be the next AMC 2.0 based on this. All right, so based on the social media kind of trending factors, we can see that this stock could potentially be one that a lot of this rated players might be looking to target moving forward after AMC, after GameStop. And especially this is a stock that is backed by Sharmaf, who is pretty well known out there as well. But beyond that, beyond looking at social media, of course, you want to take a look at what is the underlying behind the stock. You want to know that there's actually a high short percentage of float so that they can actually be ideal candidates for a short squeeze. Okay, so over here, Clover Health is one of the stock that has a high short percentage of float, 36%. In fact, one of the highest among this list, probably only losing to Big Bath and Beyond, which also has recently appreciated pretty significantly. So high short percentage of float is one key ratio that you should be looking at. At the same point of time, rising volume. So basically this platform allows me to track the volume of this counter last night relative to the average 3 months. So you can see that last night's volume for Clover Health, for example, is 5 times the norm, the average norm over the last 3 months. So increasingly, there's going to be more interest in this stock. And if that's going to be the case, rising volume accompanied with rising share price, that's where you know that this could again be a good candidate for a short squeeze. All right, but take note of many of these stocks are not backed by fundamentals, which makes them high risk momentum counters. So please do your own duty, and once again, position size your stocks. If you, let's say, you really want to partake in this kind of short squeeze play or potential short squeeze play, please make sure you position yourself well. Don't over leverage. Do not speculate too much. Know for sure that, okay, this is the amount that you are willing to lose, and you are willing to lose all of it. And make sure that you buy the right number of stocks as per what I've just now shown you in terms of calculating that figure. All right, so on my part, I think Clover Health could potentially be the next AMC, but again, this is not a recommendation for you to be buying it. It's just for reference, and this is something that I actually screen it on a daily basis to kind of like see which are the stocks that is potentially trending at this point of time. Stocks that have high percentage of shorts relative to their float, which could be very good short squeeze candidates. And if I see there's a rising interest in terms of volume, people are playing it, and the share price is rising quite substantially, that's where potentially I might want to punt a little bit on the back of that. All right, so that's just me. All right, that's just me. I'm not sure about Nicholas.
Nicholas,
would you be looking to...
I mean, it's wonderful you're laying it out for us. Okay, what I want to ask you, how do you speculate with care? That's so ironic. Okay, but anyway, seriously, folks, I hope you know what he meant by that, because clearly, I think it's almost more of a gamble, if anything. Okay, so I think if I can just sum up a few things, you know, one, okay, I talked about how this bubble is a bubble and how some of the signs that it could end, and what do you look out for? Okay, please go through this and look out for those signs. More importantly, Royston also managed to frame it in terms of framing the whole thing in terms of suggesting basically how do we approach this. I mean, it's crazy. It may be crazy to just be on the side watching this whole thing go by, because there are people making good money out down there. Okay, but if you approach this, what do? The strategies and the techniques one can use. And clearly, what Royston has explained, I think sounds to me like what you would do when you go to the casino. You take $1,000, you say, hey, look, I'm going to lose this $1,000, okay? And I'm going to do it maybe on 10 bets, losing each bet $100, for example, okay? If I lose that $1,000, what happens? I walk away. So I'm going in with money I can lose, number one. Yeah. Number two, okay, if I keep making $100 along the way on every bet, I hold them and I move up a break even. Why? That allows me a plan to be able to walk out eventually with some profits also.
Yeah.
So in actual fact, it is almost like a gamble to some degree, because clearly folks like Royston and I both have mentioned to you many times, these moves are not backed by fundamental, not backed by technical. And lastly, I think the juiciest part, how, Royston has just pointed out, how can we spot these next potential AMC 2.0 names that are probably going to be featured and could trigger, a new move in the whole in the whole meme stocks arena. So I really think that I think it's something that I hope you guys understand and you guys find it useful, and maybe you can come back to me with some comments and questions.
All right. Okay, I think that's.
And I hope you like our
that...
new background also. Okay.
Yeah. Cool, right?
Yeah.
Okay, I guess that's about all that we have for our viewers today. So come back next time round. I guess we're going to have another very interesting topic the next time round for you guys as well. But today's topic is definitely something that is of interest. A lot of people are interested to know more about the current meme stocks and where it might potentially trend. All right, where it might potentially trend. So again, be careful if you want to play with this kind of volatile stocks. I think at this current juncture, it does seem like the music is not yet stopping, but be prepared and be nimble that when the music actually stops, you have to be ready to get out of the party. Okay? All right.
Man.
All right. So with that, thank you, everyone. I'll see you guys next time round. Thank you. Thanks,
Bye-bye.
Nicholas.
Thank
Bye-bye.
you.